Good morning, everyone. Welcome to this update for the 9th of July. Not a lot happened last week of significance, so this will be a shorter video. We just saw a continuation of some of the action that we've seen now over the last few weeks. Money continuing to favour sectors in America such as financials and healthcare and industrials. Although we did see, after selling throughout the week in technology, we did see a pretty nice rebound on Friday night. And certainly some of the higher volatility sectors of technology had a lot of volume associated with them. So there was a lot of confidence about the buying in those more volatile sectors. And I take that to be a pretty positive signal. So let's have a look at the action for last week. We're going to have a look at just the current state of stocks and commodities. But as I said, not a lot has changed. Have a look at whether the signs are that the tech correction is finished or whether it's still got some way to play out, and also what sectors are being supported at the moment. And I guess the other major move of the week was that gold and oil are really extremely weak, and when you consider some of the geopolitical things that are going on, that's a little inconsistent. So overall, American stock index, the main stock index was up 2 points for the week. Dow Jones was at a new high. From a valuation point of view, which is what the bears want to keep pointing to, the market's ridiculously overvalued because of some ratio that they use, which tends to be backward-looking rather than forward-looking. The earnings yield, so this is not the actual yield, this is not the dividends that companies pay out, but this is the earnings yield. So this is their rate of earnings growth divided into 100, and that earnings yield is 5.6% across the S&P 500. And when you compare that to the 10-year bond yield, which is around about the 2.4 mark at the moment, you can see that equities are still attractive relative to bonds, and that's, I guess, all that you need to know from a big picture perspective. The main indices moved higher, so marginally higher. So the Dow, the Russell, and the S&P, but look, there wasn't much in it. And it remains more of a market that is rotating from one sector to another, so taking profit in the sectors that have done very well and putting that money to work in other sectors that have perhaps lagged over the last year or so, rather than a reduction where money is coming out of the market. But as I said, technology did have a pretty solid reversal on Friday, so that'll be interesting to look at that one. The Nasdaq is really the key to this market, in my view. If we get a breakdown of the recent lows in the Nasdaq, then we'll probably see the whole market pull back a level. So I think the Nasdaq is critical. So let's go and have a look at those particular markets. So we'll start with the S&P. And you can see that we did have a dip with a bit of a recovery on Thursday of last week, the week before. We came out of that, so obviously there was a little bit of buying came in on Thursday. The market managed to jump up into Friday, and then we went down. It was obviously a shorter week as well with Independence Day. We had a fairly sharp sell-off on Thursday again, but a nice reversal. And you'll notice that the market is wanting to bounce off this blue 50-day moving average line. Got a little bit under it here in April, and again just for a session in May. But the 50-day moving average is still providing pretty reasonable support. Now, if we pan back, you can see that every now and again the market does dip just a little bit deeper and makes it back to the red 200-day moving average line. And if we were to get a correction of a bigger dimension, then that's probably the target that we should be looking at. So at the moment, that is probably likely to click in unless it went there in a very short space of time. It's likely to click in somewhere around about the 2340 mark if it were to occur, and that would also line up with these lows through here. So if there is a bigger correction, and I'm not saying there is, then probably 2340, 2350 is the area to look at. And with the market closing at 24.25, that's around about 80 points below where the market is at the moment. So it's still a pretty mild sort of pullback. We're only talking 3% or so. Let's take a look at the Russell index now. So the small caps, and you can see the small caps are still uninterrupted. There is a very mild uptrend been in place all year. Some would look at that and say it's flat, but there is a slight mild uptrend, and we're trading towards the top of the range. So there's been no sell-off in small caps. That's the bottom line. The Nasdaq, now you can see these are the lows I was talking about through here. Low on the 18th of May. We've come back and we've retested that low. So at the moment, this is a very mild pullback. We haven't even made it to the 38.2% retracement level, which would kick in around the 54.30 mark. I can't tell at this stage. So the answer to the question, is the correction in technology finished? Not enough information yet. There was a solid bounce when you look at some individual stocks and sectors within technology, but overall it's just too early to say. But this is a critical level. The Nasdaq around 55.70. If that breaks, then I think we could expect to see perhaps another 100 to 150 points come out of the Nasdaq, and that would very likely pull the rest of the market down as well. But look, whatever happens, the signs are still that we're going to have a good second half, that the second half is likely to be stronger than where we sit at the moment, and we may see a bit more volatility, but look, there's really no change to the outlook in my view. Now, the US dollar index, we had a very sharp sell-off the week before last, a little bit of a recovery, so there's some evidence there that we're forming a bit of a base in the US dollar, but it has been very weak. And if you look at that trend, there's a very, very clear and powerful trend to the downside. So if we then bounce to the gold index for a start, let's look at it on a weekly chart. So the US dollar index has been going down now for the last 6 or 7 weeks, and yet look what's happened to gold. Gold has fallen from close to 1,300, and we finished the week down at 12.13. This should have been an environment where gold should have done better than it has. So not a particularly encouraging outlook for gold in the short term. But if we zoom into a daily, and you can see we've now broken that trend line, and we've obviously blown apart the theory that I was proposing before, which is that gold recovered after the rate hikes. It hasn't this time. We got a very weak little bounce, and now we've gone down further. We are getting close to oversold on a short-term basis, so I'm expecting that we'll see a short-term move up in the gold price. But look, it's very strange with what's going on with North Korea. I would have expected gold to have been a lot stronger, and the US dollar going down. So gold is not behaving well at the moment. That's certainly the bottom line. Just while we're here, we'll look at the Australian index, the ASX 200. And you can see we ended up down a little bit on the week, but we just remained stuck in this range. We broke above the 5,600 level back in late December. We managed to scramble up to around 5,900, around 5,965, and we've just been in that range ever since, and we're back down towards the bottom, and we've spent most of the time in the lower half of that range. So the Australian index really struggling to get any traction. That, of course, is about the Australian banks, and as you know, I just don't see what is going to propel those bank prices higher. So I have no expectations that the ASX 200 index is going to be moving higher anytime soon. Now, the Aussie dollar still remains around the 76 mark. It's stronger than what I would have expected, but I think with the US dollar forming a base, we may start to see the US dollar bounce back a bit, and that'll probably pull the Aussie dollar down into this lower trend channel. So just to summarize, the Aussie dollar at 76, and our index was down by 17. And again, we had another very soft finish to the week on a Friday. So our market is closing in a very, very somber mood. So precious metals, gold down nearly $30. Silver broke down very badly as well, worse than gold. And I'll just go back and show you that chart in a moment. The holdings in the main global ETF of GLD fell again. If you recall, a couple of weeks ago, we were trading up around the 865 mark. We've now lost about 30 tons out of that ETF. So some of the longer term investors are withdrawing some money from that market. And when it comes to precious metal stocks, they're really ignoring North Korea, and I find that very strange because, on the surface, you would think that North Korea continues to defy what everyone expected. They just continue to push ahead with this program, and I don't think anyone really foresaw that they would be able to launch a missile capable of reaching the US mainland. People were talking about that taking another 2 years, so they've surprised everybody that they've been able to do it so soon. And yet precious metals are not reacting in any shape or form. So therefore, the market is clearly putting very low odds on that situation on the Korean Peninsula escalating any further. But when you look at it from the outside, it's hard to see how that would be. Looking at other commodities now, copper slipped back to 263. That was just a little bit of strength in the US dollar. Crude oil dipped again, back down to 44. So it's continuing to do pretty much what I expected, get down into the low 40s and then really fail to bounce. So unless you're a speculator, short-term trader, this really remains a no-go zone for investors, because I'm not convinced that we've seen the bottom yet. I'll just jump back and just take a look at silver. So you can see there, silver broke down quite badly on Friday. That was the most negative session that we've seen. You've got to go back here to March, and again back in mid-December to find sessions as weak as those. So not particularly good scenario for precious metals. And finally, just to wrap up on precious metals, this is GDX. Now we have broken a trend line. It doesn't mean anything disastrous, but the trend line has broken. And still searching for some stability in precious metals. There's the spot copper chart, just eased off a little bit. So to wrap it up, most indicators are pointing to a positive second half of the year. You really can't argue with that both fundamentally and technically. On the fundamental side, the global economy continues to grow. Signs out of the Eurozone are getting more and more positive, particularly out of Germany. Stock valuations in the US are okay. As I really outlined in detail last week, they're okay relative to the relatively low bond yields that we've got at the moment. So I'm not perturbed by valuations. There is no exuberance in the market, so we haven't had this excess build-up. And the only thing that could really disrupt the market in a more significant way, other than a very mild pullback of a few percent, is if North Korea does do something really foolhardy. And we can't factor in those consequences because we can't possibly assign a probability to them. So to me, it's just something. It's not that we ignore it. It's just that we have to go forward. You can't stick your head in the sand and not do anything because something might erupt in North Korea. So I think we just keep an eye on it, but at the moment we should just proceed as normal. All the indicators are pointing to a positive second half, and I think that's how you should proceed. So I believe a pullback in the short term is probably a little bit better than a 50-50 bet, and it will hinge a lot on the NASDAQ and that key level that I indicated. So I would only be a buyer on overseas dips, on oversold dips in this environment. I wouldn't be a buyer under any other circumstances at the moment. So that's it for this week. Let's see if anything more significant changes over the week. There's my contact details for non-members, and I'll be back with you next Sunday. Cheers.